Hello everyone, this is Torin Dove on the Dove Financial channel, and thank you for checking out this video. Today we're discussing everyone's favorite topics, tariffs and how they're killing the market currently. Recently my portfolio has been liberated, and I thought I would come back to tariffs as I recently made another video right before Liberation Day, kind of saying some of the rumors that were popping out. And at the current time, we had rumors of around a 10% across the board tariff. And while that isn't entirely wrong, there have definitely been some major jumps. The 10% that was set out has more or less been just the baseline level for all of the countries. So really quick, I'm going to go over what exactly was announced, go through some key tariffs that have been placed on countries, and then kind of break down what that's going to look like for the US deficit moving forward, and then also talk about what you can do and how you can take power back into your own hands and properly prepare and invest so that either your portfolio or 401k isn't totally torched, or if you have plenty of time, give you a little bit of inspiration to just wait it out and not do any rash decision making. So, as I mentioned earlier, Trump's administration set out a 10% tariff across the board, but this was more or less just the baseline. And then a couple increasing figures on some noticeable countries. The European Union now has a 20% tariff on them across the board. Japan had a 24% tariff. India had a 27%, Switzerland had a 31%, Taiwan has a 32%, and China has a 34%, and then Vietnam has a 46% tariff. Now, in terms of how we got to some of these figures, there's what the Trump administration said, and then there's actual, the reality behind it. In reality, these were more just, they went by priority of countries we have the largest trade deficits with, not necessarily what was pitched, which was these countries have tariffs and blocks on us. It went specifically by we import more goods from them than we export to them. Now, obviously, these tariff numbers were quite a bit higher than the Trump administration. Rumor mills had been going from the 10% originally across the board to picking some specific countries to target, and then what they ended up going with, which has really alienated a lot of our trade partners. Now, tariffs now are at the highest they've been since they were in the 1800s. And the last time we saw tariffs this high, it was a key contributor to the worsening of the Great Depression. I know worsening's not really a word, but I think that's a word that kind of fits for that, because the Great Depression was already going on, but a lot of historians and economists alike have agreed that when we actually reintroduced tariffs, originally we thought that would actually help with the Great Depression, and realistically it made it significantly worse. And it wasn't until 1942, when we started to repeal some of those tariffs, that America really shot up to what we know now as one of the largest economies in the world that was really built along free trade. Now, since Liberation Day itself, the S&P 500, the NASDAQ, and the Dow Jones have all dropped down over 10% each. And we've seen a lot of key notable names, such as the market darling Nvidia's dropped significantly more, Apple's dropped quite a bit, Taiwan Semiconductors has dropped quite a bit, and overall the tariffs, in terms of my personal opinion, they don't really make sense. I tend to think of myself more as just wanting free trade across countries. And when I see a country like Taiwan that we poured billions of dollars into since World War II, and we've continued, especially in the 1980s and 1990s, we're a primary reason that Taiwan is the semiconductor powerhouse that we have today, because we put in so much money and invested so much money into getting Taiwan to where it is so that we could buy cheap and have easy access and have those supply chains to semiconductors that we have today. So it's a little bit annoying to see the Trump administration completely ignore all of this history, ignore the investment we've put into other countries to set up operations, such as Taiwan or even in Malaysia, where their primary product that they export is palm oil, which we don't even produce, and then we slap a massive tariff on them. it can be quite annoying because Taiwan is so far ahead of us in semiconductors. When you look at the United States players, and specifically in that space, when you look at those players, you have companies like Intel who are barely holding on. And if Taiwan Semiconductors or Broadcom doesn't step in to actually save Intel, they could go under. Now, the Taiwan Semiconductors one is interesting because they have touted for a few years now building out a $10 billion factory in Arizona. I think there's still a little bit of construction going on with that, so they'll likely still have an operation in the United States. But again, we set up this supply chain to specifically get access to semiconductors at cheap and efficient levels, and now we're kind of going back on that in a way. Now, I think it's clear to say that these tariffs won't necessarily have the effects that they've been advertised for. And kind of what I mean by that is if we take everything the Trump administration has said, like word for word, is complete and total fact, they believe that these tariffs will allow them to raise $6 trillion in 10 years. And a lot of that will be funded towards specifically targeting the U.S. deficit. Now, again, that equates to $600 billion a year that will be paid by United States customers that will then in turn go towards the government funding and specifically, as the Trump administration has said, trying to lower the deficit. So $600 billion is only 11.76% of the what the United States government raised from taxes alone last year, and that's not a small figure by any means, but it's not really effective. And then we also have to account that they've continuously talked about using these tariffs to set up some of the largest tax cuts that we've seen. And if we, again, take everything at word value, at truth value, the number that's been floated out multiple times is $1.5 trillion in tax cuts. So really, at that point, we effectively have only gotten $4.5 trillion out of that $6 trillion in 10 years, or $450 billion, which at last year's levels was 8.82% of what taxes was able to generate for us. And then also, if we add any level of growth rate, that percentage continues to drop in 10 years. So it's a really small portion of what we raise in taxes. And so it's kind of weird that they would try and implement tariffs and then also cut taxes at the same time. I know they've floated out the idea of fully funding the government specifically with tariffs, but in order to do that, even these high percentages are nowhere near enough at all. We'd have to over 10x those figures to generate enough money to actually run the government, and they'd continually have to increase with inflation, and I just don't think that's a realistic goal. And also, I don't think that the United States consumer is at a point to take on all of those extra expenses and the rising cost of living that would come with solely floating the government based 100% off of tariffs. Now, a little bit in what kind of happened today. This isn't necessarily today, but China did announce pretty shortly after Liberation Day that they were going to match the United States on 34% across the board for United States goods and tariffs. And I kind of find that a bit funny because specifically on the board, every single figure that the Trump administration came up with to target on tariffs, they said that it was half of what we were currently being charged in tariffs. And the news wasn't China dropped its tariff percentage from 68% to 34% to match the United States. It was they created new tariffs. So that kind of goes against the entirety of what the Trump administration was saying, at least in my eyes. I'm not trying to necessarily make this a giant political thing. I've said my opinion in previous videos. I can only keep saying my opinion and point out that the United States is the #1 economy on earth, and we should probably not try and ruin that. I can only repeatedly say that, but this screams to me a lack of understanding between what a trade deficit is and countries taking advantage of us. We're a services-based economy. That has been the case. A lot of these countries we have poured money into to build infrastructure and get cheap goods from, and how are we expecting the same crowd who last year complained that eggs went up $1.20 per carton to now pay 3x what it costs so that they can get American-made goods. I don't necessarily see that happening, but again, cutting away specifically from tariff talk and how the administration is handling that and what I would do, how does this impact you? So I've said this repeatedly in each of the videos that I've made covering tariffs. You can absolutely expect volatility, and I highly recommend not panic selling. And specifically why I talk about that is something else happened today that was kind of interesting, but I think really pins this point. So the past 2 trading days, the market tanked over 10%, right? And today we had a rumor come out, and again, this was just a rumor that was completely unfounded, but I'm going to make the point of what if this were true in a second. So the rumor was that the Trump administration was going to hold off for a period of 90 days on these tariffs. It got pushed out on social media, and people for a brief, probably like 8 to 10 minutes thought, oh, this is true, and the market immediately shot up 2%. Now, had that been fully true, it would have continued to rise up as, hey, maybe there's a chance that we negotiate moving forward and we all kind of cooperate and we don't slap on a bunch of taxes, basically, for United States citizens. But that was a rumor. It got quickly found out to be a rumor. And very quickly, the market continued to go straight back down in a matter of 10 minutes. It was kind of entertaining to watch live. It was just trying to figure out, okay, what's happening? Why are we suddenly going up? And we're back down. But the point being that if you panic sell at a time like, let's say 2 days ago, if you had panic sold at minus 10% and that had come out today and that had been true, the market would have shot back up and you would be much, much better off than having locked in that loss. So I wouldn't go about locking in any of your losses or realizing any of those losses unless specifically, and this is like a very rare instance, but if you are trying to use those specifically for tax purposes, if you qualify, then that is a completely valid approach to this and understandable. Maybe you've had a lot of gains in the past few years. I mean, the markets have done really well since 2022, and you might be able to realize some of those losses now. Completely understand that. But I would instead like to push forward a different alternative approach. If you do currently have no idea what's going on, you're feeling really panicked, and you need clarity in order to properly hold through this or come through with a strategy that'll actually benefit you. So if you are wanting to lose much less than the market could potentially lose if you think it's going in a downward direction, I would highly advise going to Morningstar and looking at low beta ETFs. Now, what I mean by low beta is the measure for risk. The S&P 500 has a beta of 1. And basically anything below that is supposed to be, in theory, significantly less risky. So whereas if you were solely focusing on VOO right now, you'd have the Mag 7, which again, NVIDIA, Google, Apple, the Mag 7, a lot of large tech companies also in there, and it would be a much more volatile down ride as opposed to holding something like SCHD, where you have a lot of Chevron and energy companies and Verizon. And these are solid dividend-paying companies that, while they might not get you the most attractive gains in a bull run, they can definitely limit your downside potential a lot compared to solely investing in VOO. Now, again, I brought up not panic selling, and that's kind of because this has happened before. And maybe we're still very early on, so this could rival the Great Depression for all we know in 6 months, or this could just easily become we negotiate with countries, we think we've won the trade war or whatever, and we move on, and in a couple of years it doesn't matter. We can't say. What we can say is historically when this has happened, there have been great buying opportunities that have made people rich. And how you can kind of try and take advantage of this is maybe switching your approach a little bit to a dollar cost average approach. So maybe you commit a certain amount of capital each paycheck to go in to your investments, or even if the market continues to go down, you might ramp that up a bit. And kind of what the argument behind this is if at the bottom of the 2008 financial crisis, you had invested $10,000, only in the S&P 500, today that would be worth $107,000 and 500 extra dollars. So again, there are really good opportunities right now. I know this is a stressful time, but two things I wanted to bring up really quick that might be able to help you with those stress levels and understanding are some key lessons that I actually learned from Benjamin Graham's The Intelligent Investor. And I think if you have actually read through that book before and you have heard these, it might be a good reminder. Or if you've never heard anything about The Intelligent Investor and don't know who Benjamin Graham is, that's completely fine. But one of the things I really like is compare your investment portfolio to your house, just for this example. So if somebody is constantly 24/7 offering you prices to buy your house, you're not going to have bought your house for $500,000 and then sell it for $400,000. It's a house. You can live there. You exist there. You don't want to lose $100,000 on a house to then be homeless and not afford another house. You wouldn't necessarily take something super low. Now, if somebody offered you 200% more than the house is actually worth, on best estimate, you might be much more likely to sell your house. But again, at any given point, the market is always offering to buy at whatever price it deems that day. And this kind of goes into the Mr. Market example I'm going to throw out in a second. But in essence, you wouldn't necessarily sign up right now as the price of your house is shooting down to sell your house. And investments are quite similar, especially if we're talking about your nest egg and your retirement settings. Like, why on earth would you sell that at a significant loss? Now, going into the Mr. Market example, basically Benjamin Graham goes, and this is like a whole chapter in The Intelligent Investor, on how Mr. Market is kind of a manic depressant, right? He's always offering, he's always like running up to you every single day. I'll buy this company from you for this amount. And then the next day, if it goes down, I'll buy this. And he's just constantly bothering you. And there are always opportunities. But that being said, some days he's offering significantly more than your investments are worth. Some days he's offering significantly less than your investments are worth. You don't have to act on it just because somebody's willing to buy it. The market is always 24/7 willing to buy your investments, and you shouldn't always 100% of the time do something. You don't have to. Sometimes just waiting out until you get a better offer is the right move. And then additionally, in market turmoil, which is kind of what we're going through right now, there's a lot of times where you can actually buy from Mr. Market, and he's really going at fire sale prices trying to get rid of his equities. And there's a great chance that you can get solid deals moving forward, especially if the market continues to go down. So really, primarily, the two takeaways I would say is exercise emotional control. Come up with a strategy that you think can properly allow you to really benefit from times like these, and don't panic sell. And then additionally, if you are somebody who really likes the idea of leveraged ETFs, I absolutely love leveraged ETFs, and I think during the right time to purchase them, they can be a great benefit to you, especially in life cycle investing. I wouldn't jump into it right now. In my own personal opinion, the best time you see with leveraged ETFs is when they're going to be towards the bottom of a bear market, and we're just really early on the tariffs. We haven't even hardly seen the effects on a customer basis. Give this a while. If these tariffs do actually stick around like the Trump administration has said they will, trust me, there will be plenty of opportunities to buy leveraged ETFs and really gain upside. But thank you again for coming into today's video and checking me out. Hopefully I helped you feel a little bit more comfortable with what's going on in the market and kind of summarized what all is going on with these tariff concerns. And again, hopefully you can kind of set out a clear plan and path for your investment strategies moving forward. Thank you very much.